What's up, YouTube? It's Joe Catchpollia sitting on the couch making some money investing in fractional real estate online as usual. Today I'm going to talk about Mogul's latest offering, the Wagner. This is a 7-bedroom, 3-bathroom Padsplit in Atlanta, Georgia. It's been operating for 2 years. There's a lot I like about this one. A couple of unanswered questions, but I'm going to get to that. So last year's income was $63,000, and they're only underwriting $60,000. So compared to the last one, I like this income, the way they're handling this income much better. Right, they're projecting something below the prior year. Let's see, an existing pad split. It's 100% occupied currently, which is nice. This one is amazing to me. Strong resident retention with 14-month average tenancy. If you talk to the people at Padsplit, they'll tell you, depending on what market you're in, you might expect 7 months, 9 months. So 14 months is a really strong average tenancy. Now this property, it was renovated in 2022, and so it was a brand new property 4 years ago when it started operating. Sometimes that can help with retention. Now, is it starting to get tired 4 years later? That's is a question in my mind, but I think there's probably other aspects of the property that lend itself to the longer retention. I'm going to talk about that a little bit. A couple of things that I wanted to point out right away is this Mogul one-time fee. This looks like this is 7%. I think last time it showed up a little high too at 6%. I think we need to ask them, did their fee change? Because I don't know if that's really what's happening, or if it's they're sticking. See, that fee always adds up to the same thing as the miscellaneous cost, and I'm curious if this is just pulling from the miscellaneous cost and they've started adding some things into here and that makes their fee bigger, or are they really charging a 7% fee now? That would be really surprising to me, because they had initially started at 5 and they said they'd expected it to go down. So if it's going up, it's definitely something we should ask about on the next webinar. If I'm not there again, somebody else, please ask that question, because it is, I think, pretty important. If their fees are moving upwards as their yields are moving down, that's not a good trend for either. Speaking of their yields, the year one yield on this 8.3% is their projection. 8.26 is the actual number. Still lower than some of their earlier deals, a little bit higher than what we've seen lately. I'm pretty happy with that number. For relative to what we've seen in the marketplace. I think that's, especially when they're underwriting something that's below the prior year's income, I'm pretty happy with that. So let's see, a couple of things I wanted to talk about. We have an extra document here that we don't normally have, an amendment to the PSA, and so this is interesting. This is the original PSA. One, I wanted to point out, this is one of the worst filled out contracts I've ever seen, right? We don't have an offer date. We don't have a legal description. They say, okay, they're a new loan to be obtained, but no details about the amount or anything. If one of my team members came to me with a contract like this, I'd be like, go start over. I don't know how we ended up with this. So this was surprising to me, right? Not even a date, because I noticed the date because I was trying to compare it to when it was amended. Sometimes you don't see legal descriptions filled in, although I think in some states you don't even have a binding contract with just an address. You actually have to have a legal description. I have no idea if that's the case in Georgia. But not having a loan contingency but not having any amount in there, that doesn't work where most of the places where I've worked. So I don't know. I just wanted to point that out, because that just seemed really strange to me to have so many things that were blank. And then there is a section, they have, let's see, where is it? They do have the appraisal contingency checked, but we don't have this exhibit. So I went just to look to see what that exhibit looks like. I found a blank one. I don't know if this is the one they'd use or not, or if this is the one that was used. Hopefully it was actually used and it's just not attached to our contract. But the reason it's important is whenever you have you have your contract and it says, look at, this exhibit is attached. Theirs is pretty innocuous. It just tells, your amount of days and whatnot. But in some states, the appraisal exhibit actually will say, it only has to appraise for X number of dollars, not necessarily the purchase price. So I wanted to see what that looked like, especially because the amendment that we got is reducing the purchase price from $435. So they originally had it under contract for $435 and dropped it all the way down to $375. Now my guess is that that is due to the appraisal coming in, and so they reduced the price quite a bit. It would be amazing if that was part of, if they actually told us that in here, right? Like when we have two documents and we can see, okay, they were originally going to spend $435 and now we're actually just spending $375. What happened, right? Did we do an inspection and, there's $60,000 worth of work we're going to do? Well, that's not good. Or did we just do the appraisal and we realized, hey, it's worth much less, and they agreed to lower it? Now, as part of it, they also, the buyer, us as, Mogul, or us as the investors, are paying all the closing costs. So, that's more cash out of pocket, but a $60,000 reduction, something to be pretty excited about if it's just based on the appraisal. But one thing I really don't like about this is, if you think about it, Mogul was willing to buy this at $435, and if my assumptions are correct, it actually only appraised for $375. That seems pretty crazy to me, that, the upfront due diligence that they did would be $60,000 off on what it's worth. And this is kind of in line with what I've seen a lot from, I've complained a lot about, I feel like we're overpaying for stuff. And so I don't know. I don't know that that's what happened here. Maybe that price reduction came from some other reason. But if it's based on the appraisal contingency, it would mean that they were willing to pay well over what the actual fair market value is. And I think that's, I don't know, I'm starting to get nervous about their selection process and how they're looking at deals. And, some of it might just be that it's not being presented well and we're not getting good explanations, and I'm having to make assumptions. And being a, very conservative investor and someone who's just always looking for reasons not to invest, if I have I'm always going to assume that the worst if I don't have an answer to something. Now obviously I could ask them, this has only been up, it's almost 2/3 sold out, or it's around 2/3 sold out. It's only been up a couple of days. So, the ability to actually ask questions in a timely manner and get a response before it sells out is not really there. And from their perspective, if people are just buying this without getting those questions answered, then that's, they have plenty of customers that are happy with that. So I don't know, but I'm that makes me super nervous that, they're willing to spend $435 on something that potentially only appraised for $375. And then once we get it down, okay, so we got a $60,000 reduction, but we're still just getting an 8% yield. Like, what was this going to yield when it was originally under, was it just lower, or did they just tweak the numbers to keep that, the yield consistent with their other properties? Were they willing to stretch more on their underwriting, and then they realized, we got it cheaper, so we can back some of that off, and it still looks like a lot of our other deals right now. Those are outstanding questions for me that I'd want to know. A couple other things that I want to talk about. Okay, 7 bedrooms, 3 bathrooms. You guys know my opinion. Less bedrooms is always better if we can make the numbers work with less bedrooms. So I like the 7. I think in Atlanta it's less important because this product is very established, right? Padsplits started there. It seems like they're just accepted. They're not running into issues. But 7 bedrooms looks like a lot for 1,500 square feet. This is something we've run into in Atlanta specifically before, and I remember this, that their finished basements don't count in their overall square footage. So if you look at that 1,500, that's the square footage, but we have another $400 in finished $400 square feet in finished basement. And so I think that makes sense. Okay, really, we have almost 2,000 square feet. We have 7 bedrooms. That math works for me, right? Like if you've heard me talk before, I think 2,000 square feet for an 8-bedroom pad split is sort of the standard. And so, okay, we're just slightly under 2,000. We are 1 bedroom less. Makes perfect sense from that point of view. Let's see what's next that one of the things that I thought was interesting when looking at the the owner information, it's currently owned by Dream America Homes. If you don't remember, that's this company. This is the company who is managing the more recent Florida Padsplit that Mogul is buying. But in this situation, we're buying from them and using a different manager managed by CPM Management or CPM Partner. So I think this is the management company we've used in Atlanta. But I just thought it was pretty interesting that we're buying from a property management company that we're using in another market. That lends itself to, okay, we're buying this. This is an off-market transaction offered exclusively to Mogul. A lot of people in the Discord questions, is this true? Because it's currently listed at $450 on several websites. So how is it off market if it's currently listed? Like, that doesn't make a lot of sense. I did look at some of these websites. It didn't get great valuation. One, they don't have bed baths or square feet in any of these, which makes it so you don't always get values. But I actually, and sometimes when it's listed for sale, that you don't get the values either. But you can see, okay, this was listed in 2023, $269. They try to list it at $294. So we're well above that, right? We're $80,000 above what they tried to sell it for in 2023. I don't think I still have it open, but let's look at let's copy that. What are we doing here? I don't know why. I've started to get in the habit of closing tabs too quick. Now let's look at the Zillow home price trends in that zip code. Yeah, over the last year, it's gone down almost 6%. The this shape we're used to seeing, but there was a little bit more pronounced downturn. But so we are paying significantly above. The last time this sold was in where is it? In 2022, which you can see, was the peak in the market, and so we're paying considerably above what it paid for at that time. Might not be a big deal because it looks like they fully renovated it then. So we don't know the condition of the property. Zillow actually has this estimate of $437, which I was like, oh well, that's good. That's well above what we're paying. But if you look at their estimate line, okay, well, it just shot up because it's using the data from the listing. Like, this is one of the things that we've seen over and over again. When a property is listed, it pulls up some of the estimates and some of the estimates on different websites. So, okay, if we look back, they thought, just a couple of weeks ago, Zillow thought it was worth $200,000. So that makes me pretty nervous from a valuation perspective. My cat is attacking me while I'm trying to do this video. But like I said, I do believe that our price change probably came from the appraisal contingency. If that assumption is accurate, then, well, this 375 is probably, and I'm going to say we just don't know, but it's probably what it appraised for. I think it's perfectly possible they're stretching a little bit, though, because we've seen that in the past where they had a property under contract, the appraisal came in low, we didn't negotiate it all the way down, they went most of the way down, and then because they were able to change some other assumptions with the debt, am I thinking about it the wrong way? I think that's what it was. I'll have to think about what deal that was. If anybody remembers, go ahead and put it in the comments or jump in the Discord. But there was one that they had to, when they changed the numbers, they changed some debt assumptions, so they had to, so they were able to still pay above the appraisal, change the LTV assumption, I think, and still make their numbers work. So I think it's possible that it appraised for even less than this 375. Which is, again, why it would be just great if, when we have something like this, I appreciate that they shared the amendment, but I'd like to know, it would be great if they told us what actually happened. And that's, it's been a complaint now for a little bit that we're just not getting as much detail on some of these listings. I think that there just needs to be a little bit more story to these deals. Like, I think this is great, right? I like to know, okay, we're above or we're estimating below the actuals. It's been operating for this long. And a lot of this is good info. But like when there's something like a $60,000 price reduction in an amendment, which is good news, right? Sort of. You know, you heard my concerns about it. I want to know why, right? Because if this $60,000 reduction is because of property condition, well, that's not necessarily as helpful. That's one other thing I wanted to talk a little bit about. So we see, where all of these, our closing costs, loan costs, vacancy reserves, maintenance reserves. I'm very glad we have this 10% reserve here. But when we look at, okay, now we have this 7% miscellaneous cost. Is this whole thing the fee plus 5% closing costs, which on the buy side is typically high, plus 5% loan costs? Like, we're talking about now about $96,000 in addition to, we're raising $93,000 in equity for the down payment, and then another $96,000 on top of it, which less than or around 40% of that is reserves. And so the rest of it is some sort of transaction cost that we don't really have details on. That's a lot of money in transaction costs to try to overcome when we think about selling this property in the future. So I'd really like to get more details on what's going on here. Are we paying really, are we paying really high loan fees? When this says, if you look at this, it says typically 2 to 3% of loan value. We're at 5%. We have been on several of these. Closing costs comprising 3% of the purchase price on average, where we're at 5%. And then again, the miscellaneous cost being up to 7%, where they have been 5%, 3%. This does talk about, like, some of this is startup costs, but we're buying this turnkey. So where is that coming from? I am just starting to get nervous about Mogul. I'd like more and more info over time, and I feel like we're getting, it's been sort of static, but the trends have been in the wrong direction for us as investors on some of these numbers without an explanation of why. I mean, especially, this 7% miscellaneous, which is also equal to this Mogul platform fee, that number moving up, one of the worst trends from our perspective. So I just want to know, is that really what's happening? And if so, why is that moving up when we are told it'll probably move down over time? All right, let's see. Let's get into the property itself, though. I did check the flood map. It looked perfectly fine to me. I was very happy about that. What happened here? We got an ad popping up. This spot crime map is the best spot crime map I've seen in anything in Atlanta. It made me wonder, like, are we just getting a reporting problem in this area? Because we've never seen it so good. Maybe that's a big part of why we have good retention here. I don't know for sure. I did use the Padsplit calculator to look at the revenue, and I couldn't get it to, this is gross effective, but usually this 60,000, you would subtract, the platform fees and get you to 51,000, which would typically be the number that adds up to their top line rental income. So I don't really know why we're so far off. My guess is because they have very low turnover currently, and so you're not getting the big vacancy number. You're not getting as much move-in fees. You're not getting as much of the booking fees and whatnot. So that makes some sense because they have a very long average tenancy, that their top line number would be better than what the calculator expects, the Padsplit calculator. But you would also think that they know that in that area you might have longer tenancies. It makes me think it's the property itself, not the area that's creating that. And because we know that it was already operating at that level, and actually they said it was 63,000, and so, or over 63,000. So they're not expecting to do as well as last year until year 3. That seems pretty conservative to me. This is back in the, this is the way that they were underwriting properties early on. I am really concerned like that this only is the case that this is their underwriting because they got the big price reduction, right? Like, I mean, it was over a 10% price reduction. Were they being more aggressive with this and they scaled it back? I'm not sure. The other thing that I'm curious about is, this was run by a management company that they're using in another market. So maybe they're thinking, okay, well, we can't assume we're going to do better than them because we think they're a good operator as well. I think that's good if that's the way it's going. So I actually really like that. I think, the revenue side I'm pretty comfortable with. Let's see, I already did the Zillow home price trends. Yeah, and so the only thing, the valuation number really worries me. Not understanding where that big price change came worries me as well. If it came from an appraisal, I'd like to know what the actual appraised number was, because, whenever I've been under contract or helping a client, if we come up with a low appraisal, I'm never wanting to pay over that appraised amount, right? Like, we don't know. It might have appraised for $330. We negotiated them down to $375 here. And because of other assumptions, the deal still works. And so Mogul's happy moving forward with it. That just makes me nervous, especially when I can't get, when the only real third party numbers are just skewed upwards because of that really high listing amount. And why, if you think about this, why did this just get listed? Let's see, you can see it's only been 9 days on Zillow. So this basically was listed the same day the amendment was signed. We don't know how long after the actual purchase contract it was, but that is just it's really weird that happened. Maybe they listed it because they got worried that we weren't going to go through with this, and so either that, maybe they did it because they wanted to prove that there was demand for it at this higher price. I'm really not sure, but you guys know me at this point. When I don't have answers to questions, I don't buy something. It's really too bad because, I really like, several things. Oh, and I didn't actually show you the property itself. You can see, okay, this is a 9-minute walk to the bus stop. Okay, that's not too bad at all, right? Less than half a mile. And then it's, you can see people they're just parking on the grass here. I guess that works, right? I really like the neighborhood. It is almost a half-acre lot. It's like 0.44 acres or something. So there's a lot to like about the property itself. I can understand why people would want to stay here for a long time. Was there some other, if you looked at the pictures, it looks like a nice renovation. Like there's a lot to like about the property. And then because it's been operating, because it's had a long average tenancy, this is when I was really thinking I'm going to buy a piece, but I hate when there's questions that I don't know the answer to. I know I can ask them. I just started digging into this last night, and so, I don't think I was going to get a response back. But just some of the stuff, like it does bother me to see contracts written like this, right? Where we don't have, we're like, this is just very sloppy work when you have a lot of a lot of things that are not filled in. And I don't even, it's not even like it's tough stuff, right? Like your offering date. This seems like you could just pull this out of the public records, right? I'm sure we have lot and block on here. How do we not? Usually we have this in mind locally. Legal description. Oh yeah, it's blank on here. So I guess that makes sense. Maybe they didn't have it. So that's not the end of the world. But I just, the loan one, right? Leaving this info blank really blew my mind, right? Because what's the point of having a loan contingency if it's not, because in some markets, if it's blank, it's assumed to be zero. So, okay, having the ability to obtain at least $0 in loan is the same as having no loan contingency. I don't actually know if that's how it works in Georgia because every market is a little bit different. But yeah, it did make me a little bit nervous. And then, okay, it's saying we have this appraisal exhibit, but not getting a copy of it. and then getting the amendment, but not being told how we get a $60,000 price reduction. But then on top of that, the fact that we were willing, if it is an appraisal, which I think is the safest, that's the assumption that would be most favorable, right, to wanting to buy this, is that it's just appraised lower. That's much better than if it's a condition issue. But so then if that is the case, that it's the appraisal, the fact that we were initially willing to get this under contract at such a higher price just makes me wonder, like, are they, I've just mentioned it lots of times, it just feels like we're stretching it. It feels like we're willing to overpay because there's, and it seems like it's just because there's a lot of demand. Like, these are selling out very quickly. I don't know. I mean, that's, I hate this. This has been, historically for the last several months, my favorite platform. And I feel like lately I just haven't loved a lot of the deals, and part of it is that I just don't know the answer to some of these questions, right? And so if they said, yes, this was just an appraisal contingency issue, that's why we lowered it. The appraisal was right at $375. If I knew those two things, I'd probably buy this today. Is that true? Yeah, I think that, so I'm probably going to send them an email and ask them. My guess is I'd be too late, but it is, I just hate having unanswered questions about, what I think are very material facts about the deal. And that seem like that should be, cause it is, well, and I guess the fee as well is important to me, right? Like, why are these numbers growing so much? Why do we have, so we've got, less than 40,000. So over 50,000, almost $60,000 in, almost $60,000 in costs over and above the equity we're raising and over and above our, reserves. Like, that's a big number to overcome in the grand scheme of things. Now, obviously that's all baked into their numbers and their assumptions. But it's still, at the end of the day, if we are paying at the absolute top of the market, because, that's either, we just reduced it to the appraised value, or sometimes, again, and maybe it's above, we don't know. And we have all the, all this extra cost built in. Like, it seems difficult to overcome that in a scenario where we sell it in the future. Let's see. I don't know. That's it. I think that's everything I'm going to mention for today. I'd like to have one that I'm just like, yes, I'm very excited about this. Let me buy it. That's mostly where I stood on this until those two things, until I noticed those two things. So I am going to ask those questions. If anyone else already asked them, please, mention it in the comments or put it in the Discord, because I am extremely interested in that. Before I forget, please like and subscribe. In the description of this video, I have a link set up to it, or a link to the Discord I set up, where we talk about fractional real estate investing. There's a couple hundred of us, talk about lots of different platforms. I also have links to all the platforms where I currently invest. Please do your own due diligence on those sites and any properties that I mentioned. Just because I am or am not buying this doesn't mean it's the right deal for you. One of the things, I just have the benefit of, I own a bunch of their earlier properties that just had higher yields, and what seemed like safer, better underwriting from my perspective. So, it's made it hard to want to buy some and sort of dilute that initial portfolio. Yeah, I mean, that's it. Maybe I'm just getting more jaded because I've had such bad experiences on other platforms as well. And so I am just kind of going slower on every platform that I'm investing on, and want to just really see results for a longer period of time. Also, the fact that my short-term rentals aren't doing so well on Mogul makes me, less inclined to keep adding money, even though my Padsplits have done very well. I'm torn because I kind of want to buy this one. I do have like money just sitting in this account. Obviously I'd want to add some on top of that, when I made a purchase, but I've, my rents have just been accumulating. My rewards have been accumulating. But I just, I'm just being patient. I'm being selective and conservative. If I didn't own anything of theirs, I'm looking to, okay, do I want to buy this versus, just let money sit in cash? I mean, I guess I am letting a little bit sit in cash, but I don't know. I guess I'm going to ask those questions and then hopefully get some good answers. But my guess is by the time I do that, it's going to be sold out. We'll see. I'll let you know. Until next time, I'm going to just keep making mistakes so that you don't have to.